along the way. So that's why I started Trade Academy after, working for a prop trading firm and working for a hedge fund. That's why I joined Option Hotline as the chief option strategist and now the president of the company. What we're doing now is trying to explain to retail investors how to invest with a little bit greater education and, to basically trade smarter. That's always been my key, is trade smarter. If you can trade smarter, we can all make our little piece of the trading world and make a little bit of money along the way. So none of us are looking necessarily to make $10 million in a year, but if we can all make a little bit more money and do a little bit better, that's all worth it. And that's what we're doing today, is we're talking about how I trade with a directional bias. And I really want to focus on some second and third order Greeks, which is kind of crazy for most retail investors. We don't necessarily always look at things like gamma and theta as second order Greeks. And then starts getting the third order Greeks of what actually impacts the gamma of our portfolio. But I want to make sure everybody understands that as we start to get through how to make money. Most importantly, you have to leave early. Number one, you're going to get an email with a replay of this entire presentation. Watch for it, because if you miss it, you're going to want to watch it, right? I mean, if you got to leave early, you want to rewatch tomorrow, or if you had a chance to go through everything. I tend to speak pretty fast. I'll be honest. I mean, we did a presentation last week and I felt like I didn't breathe for the entire 45 minutes. That's going to be a norm for you guys as you listen to my presentations. I try to get through a lot of content, a lot of it, and it's all for free. So that's great. We do have some other paid content. We'll talk about that later. But most importantly today, I want to make sure you guys get that free educational content. You get as much as you can into your heads, re-watch it, wrap your heads around it, watch it 3, 6, 8, 12, 38 times. I don't care how many times. And if you have questions as you go through, you should email me or you should call me. I'm giving you my email address right here. That's pretty standard, I guess. But, most people that do this educational content for free, they don't give you your phone number. Well, guess what? I'm giving you my phone number. Call me. I don't care. If I don't answer, it's because I'm busy trading, but most often I'll answer. We can talk. I can explain to you more about what we've talked about today or a previous webinar or a future webinar or whatever. I don't care. Let's talk. I like talking to people about the markets. So that's my number right there. That's my email address. That's webinars@optionhotline.com. Call or email, watch for that for the replay. And of course, if you don't see the replay, call me or email me. I don't care. We'll talk. Let's talk about what we're really here for. And this is what I think that you guys all are striving to achieve. And this is my trend trading portfolio that I've put together for optionhotline.com. It's a very strong trend trading portfolio. You can see what the NASDAQ has done. You can see what it's done. So, up $27,000 and change this year. This is this year. This is not over the course of time. This is this year. So it starts at a $20,000 portfolio and it's up $27,000. This is a 135% return. So if you are a person looking to build income, this is the kind of portfolio that can do a lot of really good damage to the amount of returns you're looking for. I love this portfolio. It's great. I have now started, frankly, I didn't like this portfolio when I first started. I said, I can make more money elsewhere. And then I realized just how much leverage I had, and I started putting my own money into this. So this is a spot that I put my own money now. And I think it's for good reason. I mean, we're looking at multiples of NASDAQ return. This is multiples of any market return, any reasonable return. And it's got this nice little benefit. And we'll talk about later about how the fact that it's got a great return leverage as well as being defined risk. So at the end of the day, this is something that we're going to be talking about over the course of the day or the course of the hour that I've got you. I just want you guys to all be aware. This is good stuff. And that's what we're trying to figure out with regards to options and why they work. Reminder before we get into the good content of what we're going to discuss today, if you have questions, if you have comments, throw them either into the chat box or into the Q&A. Either spot, Steve or I will be watching, and we will make sure that your questions get resolved before the end of this presentation. And if there is one that gets missed, again, I gave you my email and my phone number. I'm going to give it to you again at the end. Make sure that you stick around for that. And you can always contact me if you have a question as we get towards the end. Today, I always lead in with why I use options. This is something that I think everybody's probably seen, that has seen my presentations before, and I'm glad that many of you are sticking around from previous presentations. I've seen a lot of your names here before, George and Charles and Alex and Andrew. You guys are all, sort of familiar names to me, and I'd like to see you guys go through this again. At the same point, we're going to go through some of that sort of old familiar stuff and remind everybody why options really generate that leverage. Now, when we go through that leverage presentation, it's going to be quick, it's going to be easy, and it's going to be difficult at the same time. So for a lot of people that like options, it's going to seem maybe remedial, but at the same point, it's going to be a different approach, I think, to what a lot of people like to look at. We're going to do an intro to options Greeks. We did that for parts 1 and 2. We're going to rehash it again. And again, I think Steve mentioned at the beginning, if you want to rewatch part 1 or part 2, go to optionhotline.com, throw up the webinar screen. You can look at parts 1 and parts 2 to make sure that you understand my deep dive into both Delta and Vega. A little different from today. Today is all about Gamma, and I made a mistake here on this spreadsheet. It should say understanding Gamma, some trend trading signals, and trend trading with hooks on Gamma. So this is all about Gamma today. With that in mind, let's just go into the option stuff and get an understanding of why I use options instead of just doing stock positioning. Whew. So we've talked a lot. We haven't breathed a lot. We're going to do a little more talking and a little less breathing. And today I want to start with an understanding of why I use options instead of stock. So we have a very simple chart here. This is basically a stock chart. This is just a P&L chart of if I were to buy 100 shares of a stock that costs $100. So let's say I have a portfolio that has $10,000 in it. Not everybody has it. Some people do, some people don't. That's up to you to figure out. Work with your financial advisor. If I have $10,000 and I want to put it all into one individual equity, that seems a little risky to me, but it's everybody else's decision. I could buy 100 shares of this $100 stock, $10,000. Here's my profit and loss portfolio, and I am ready to rock. Here's the problem I've got. If this company is actually a turd instead of a really good company, maybe I wake up tomorrow and instead of trading $100, it's trading $60. So I might set a stop loss where I want to get out if the stock trades below $90, but who knows if it's going to go to 90, 60, or 12 overnight if there are things like accounting and proprietaries. So we have accounting issues, we have other issues. Who knows how low the stock can go? I don't like to sleep anxiously, so I like to diversify my portfolio. I think most people do. And one way to diversify my portfolio and put defined risk is to actually use an option. So I can, instead of buying 100 shares for $100, $10,000 investment, what if I bought 2 of the $100 calls? Now, for those that don't remember, for those that have not seen my presentations before, that for those that are not familiar with options, a call gives you the right but not the obligation to buy a stock at a strike price at or before expiration. So what I've graphed out here is a call expiring effectively today. There are no calls expiring today, by the way. I mean, there were some for SPY, but effectively there are no calls expiring today. You've got a call whose strike is $100, which means that I can buy this stock for $100 in this theoretical scenario. If the stock goes up, I'm basically long stock. If the stock goes down, guess what? I have defined risk. So it's got a little bit of like a insurance contract or whatever kind of terminology to it. In this case, what I've done is I've done it with 2 calls. And the reason I've done it with 2 calls is because I can buy 2 calls representing 200 shares in order to give the same exact $1,000 downside. Now it changes depending upon the stock we're looking at. Some $100 stocks, you could buy 2 calls for $1,000. Some you could buy 8 calls for $1,000, and some you could buy 1 call for $1,000, and some you can buy 0 because the implied volatility is that high. So we have these stocks that just have such high volatility that you just really can't make the same kind of trade. That's something that you should call me if you have a question about. But here's a theoretical scenario. I can buy 2 calls for $1,000 instead of 100 shares. And what it does, it gives me this incremental potential upside. This is why I trade options, is to try to capture this better upside than a stock. Now, if I have a scenario where I could buy 2 calls instead of 100 shares, it means that I have the right but not the obligation to buy 200 shares for $100. If the stock does not go above 105, I will lose money. If the stock goes to $102, I am actually much, much worse off than I would have been if I had bought stock. And this is what annoys me. Okay. What we want to see is leverage by big moves. Okay. So we want to see big moves to the upside, or actually, frankly, big moves to the downside. This might sound weird to you, but I don't mind big moves to the downside if I have defined risk. Defined risk means I know how much money I can lose. If I buy the stock for $100 and I wake up in the morning and find out that the CEO is actually a scumbag and has been lying to us for years, and the stock goes down to $10, I'm losing most of my investment. But when I buy options, I know I can lose my investment and I'm okay with it. So that's how I get my leverage to the upside and I get my defined risk to the downside. Below $90, that's where I get my defined risk here in this particular scenario. Okay. I do have one quick question that has already come in, and I want to make sure that I address it. How can I view the previous and this session? Reminder, go to optionhotline.com, click on webinars at the top. You will get to see part 1, which was Delta, part 2, which was Vega, and part 3, which is today, which is all about Gamma and Theta. Valuing an option is a mystery to most. Right? We have a lot of fun with it, though. There are 5 inputs to calculate the value of an option. Black-Scholes is the most well-known model. We have underlying price given by the market. $100 stock is a $100 stock. You can't say it's a $150 stock. Now, I can predict it with my technical signals, and we're going to come back to that later. But at the end of the day, this is a given. Strike price, that can't change. So I can't predict that. I can't change that. If I don't like the strike price, I pick a different strike. This is the price that I can use for selecting my my entry point when I'm going with a trend trading or swing trading or any other type of signal. But at the end of the day, the strike price is given by the market. We have timed expiration. Again, same idea as strike price. It's given by the market. We can't change that. Once it's going, it's there. When you pick a 1 year out option, it's 1 year out, and then 6 months from now it's 6 months out, and in 3 months from now it's 9 months out, and you can go through the whole scenarios. It's basically an insurance contract. It's got a term to it. Nothing has infinite term. There are very few ways to try to structure an infinite lifetime option, and frankly, you don't want to get involved with them because at the end of the day, they're not going to be priced well for the retail investor. So what we like to try to focus on are options with less than 1 year to expiration because those tend to give liquidity. Finally, last 2, risk-free interest rate. Who cares? It's 0%. The Fed's not moving off that 0%. It's going up maybe a little bit. So 2%, 3%. There's very little risk to actually the interest rate component of options. So we're not going to worry about that. And the biggest one, which is what every market maker and every prop trader and every volatility trader, every focuses on, it's implied volatility. That's estimated by the trader, and that's the one that we don't have given by the market. And that's the one that we do have time to try to figure out and to see if we can do better than the market. So everything I'm always doing is always trying to see if I can beat the market, both on implied volatility, which I'm pretty good at, and underlying price, which I'm also pretty good at. So if I can predict the underlying price movement, and if I can predict the change in implied volatility, I'm going to really have a darn good day, week, month, or year. And that's the focus of my career. Whew. Hope everybody's got a chance to breathe, because I do not. What are the option Greeks? We talked about underlying price, which is delta. That one was a big one for part one. We basically said that risk-free interest rate rho doesn't matter. We talked a lot about implied volatility a couple of weeks ago when we did our Vega talk. And today I'm going to talk about gamma, which is change in delta relative to change in underlying price. Like, kind of a weird thing to think that a second order Greek matters that much, but certainly it does, because that's the thing that most market makers pair along with theta, which you see here in passage of time. So when an option decays, it's really more about gamma than anything other than delta or vega or rho. When I see an option that doesn't, or a stock that doesn't move for a day, my risk is theta, but my benefit is not delta or vega. My benefit is gamma. That's what I want to focus on today, is trying to figure out how I can pair gamma with a trend following portfolio. You all have your trend following portfolios. You're all looking for delta focused risk, but we always have theta risk, and we always have gamma risk and or benefit as a result of any of the options that we take on, especially when we get in shorter terms. So I want to make sure that we all think about that as we get into this sort of stuff. Now, let's visualize the gamma of an option. Here's that initial call that I was talking about. We can look at an equity position, which is the orange line, just a straight line. That's the return of being long stock. Now, in my case here, I've got my at expiration profit and loss of a call. That's in blue. Now, gamma is that curvature, that's that slope, that's that sort of parabolic return that we're starting to see in the long call P&L today. This is something that expires in a month. It was a model that I put together. It's all hypothetical. At the end of the day, what you're looking for in terms of gamma is a pickup of delta as the stock moves up. So as the stock moves down, our delta decreases. Delta, for a reminder for those that were not on for part one, is both considered the hedge ratio. It can be considered your sort of stock exposure, or it can be considered the probability that your option will finish in the money. So there are many ways to look at it. Let's look at it purely from this case as, say, your stock exposure. So when I have a $100 call at $100, my delta on these options is going to be 50% chance of finishing in the money, 50% of a stock portfolio. And as we go towards a higher dollar price, it acts more and more like a long stock position. And as we go lower and lower, it acts more and more like a lottery ticket. Okay. So that's what gamma does for you. Gamma gives you stock position when you're right and lottery tickets when you're wrong. This is why we like gamma. This is why we like long stock. This is why stock options. This is why we like trading with options, because it gives you the optionality. You don't have to stick with this position. If I have a call option expiring in 3 months and the stock is trading well below the strike price, and I've had this many a time, I can just walk away from it and say, I don't want to look at the stock anymore. It frustrates me. I'm done with it. Well, guess what? When you're long the stock, you have to actually execute the exit to do that. And that can be frustrating for many people. So for many traders, using options gives you that risk definition that makes things a lot easier to handle. Okay, so when we're dealing with a stock that's going against you, options can walk you out of that position really quickly and let you figure it out later. And that's what I like about options. When I'm long an option, it walks me out of my position. When I'm long an option and it works well, it keeps me in it. and gives me leverage. Awesome. What does gamma mean? Gamma is the change in option delta relative to the change in underlying price. So when a stock is going up, the delta goes up. That's what gamma does. Gamma is giving me more delta when I'm right, and when the stock goes down from a call, and then we're talking about call position here because there's puts as well, but we're going to focus primarily on calls. When a stock goes down, my delta goes down. It's changing and reducing my market exposure naturally. So gamma is basically riding the wave when I'm right and riding the wave or exiting the wave when I'm wrong. Love it. That's exactly what we want as a momentum trader, right? Implied volatility is expected future movement of the stock and is priced in percentage terms. This is important because gamma and theta are all really all about what kind of movement we're getting in that stock. Okay, so when the implied volatility is high, the market's telling you it expects this stock to move a lot. If you look at a stock and say it's not going anywhere, we don't really want to buy options because, at the end of the day, we're paying for that right, but not the obligation to buy the stock later on at a different price than it's currently trading at. Okay. So implied volatility is our big expected future movement. Realized volatility is the actual movement. So you have implied volatility, which says, hey, we expect this stock to move at 32% on an annualized basis, and on an annualized sort of expectation. Now, realized volatility, if we see 2% movements every day, we're going to see some pretty high implied volatility. But at the end of the day, realized volatility can sometimes be much higher than implied. Realized volatility is the actual movement of the stock. So if I think that implied volatility is too low because it's expecting 2% per day, and then realized volatility comes in and the stock's moving 4% per day, that's a great edge for me as a trader. Okay. That's what we're trying to capture with gamma, is not a change in implied volatility, which is what we were trying to focus on with Vega, which we did a couple of weeks ago. When we're dealing with Vega, we're trying to capture a change in implied volatility. Here, we're trying to capture a difference between realized volatility and implied volatility. We're saying that the market is wrong, the implied volatility is wrong, the stock's going to move a hell of a lot more than we expected, or that the market expected, up or down. I mean, I can stop out on the downside and I can have huge leverage on the upside. And that's what I'm trying to price out, is this realized volatility metric. All right. Whew. If there are any questions about realized volatility versus implied volatility, please email me. I am happy to discuss this further, but I want to make sure that this is clear. Realized volatility is what we see in the market. Implied volatility is what the market expects. We have an edge. You and I have an edge. We can try to predict the market better than what they're showing, and that's what we're going to do here every time we trade an option. What's theta? So we pair theta with gamma more often than not when we're a market maker. Volatility traders always are pairing theta with gamma. Why? Because theta is the cost of a stock not moving, and gamma is the benefit of a stock moving. Let me repeat that. Theta, the change in the option value relative to passage of time, is the cost of a stock not moving, and gamma, which I just sort of introduced here, is the benefit of a stock moving. So whether you're going up your direction and gaining that leverage, or down where risk is defined, you are getting a benefit at a gamma, and your cost of doing so is theta. Every day that this stock does not move, you get hit with theta. Get a bill every day. Every day you get a bill. Comes in the mail. Tells you, hey, we cost $38 today, $39 tomorrow, $40 the next day. Theta increases every day. So much like an insurance contract, think about it this way. If I have an insurance contract on my life that is expiring in 1 month, it's got some value. If I've got one expiring in 38 years, it's got a heck of a lot more value. But every day that passes by on that 1 month insurance contract, it's going to slowly decay. And then when I get down to 1 day or 1 hour or 15 minutes, at the end of the day, you're betting that I'm probably going to be around. So you're not going to see that the value of that contract as anything substantial, and it's going to decay really rapidly as we get closer and closer to the point where my insurance contract ends. That's what we're doing here. Theta is the change in the option value relative to the passage of time. Each options contract has an expiration date, and as you get closer and closer to expiration, it accelerates in the way that it reduces its value. Okay. Whew. So that's theta. I mean, theta is it's a nasty little beast. It's one of those things where for those traders out there that like long options, like I do, we talk about how selling options is risky and can create generous income for 70% of the trades you do, but it can kill you quickly. Buying options is a theta risk thing. It's death by 1,000 cuts. Okay, so every time you buy an option, you are risking that cut. That cut is the theta. You bleed out a little bit every time, and then every once in a while, when you get one right, it pays 3 to 6 times what all your wrong trades did. That's swing trading. Today we're talking options trading for a trend. Trend trading, I tend to just basically look to offset my theta in order to generate great leverage. Next one. Do I want long gamma for a trend trading program? Yeah, I mean, I do, but I don't, right? So gamma is all about generating that leverage and getting that quick delta pickup. So yes, gamma, also known as curvature, is crucial to creating leverage. That's the case for every trade that I'm trying to put together. But no, it comes with a cost. That theta we just talked about. Do I really want to pay for small moves every day? If I have a stock that's moving up a little bit, like 0.5% every day, and the implied volatility says that it's going to go up 1% every day, that's not a generous return for me. In fact, I would have been better off just being long the equity. What it does give me, and what long gamma does give me, and what this paying theta does give me, is the fact that I have leverage. So I can buy a couple of contracts instead of 100 shares. I can, we talked about that scenario before. Instead of buying 100 shares for $10,000, I could buy 2 calls, $5 each, times 100 shares each. I can spend $1,000. I still have $9,000 in my pocket. That's how we get leverage in a defined risk trade. So it's less about theta. It's more about diversification and leverage. The delta is my primary source of profit when trend trading. That's what we talked about in part 1. Again, I urge you, go back to part 1. If you didn't see it, optionhotline.com, webinars, part 1. Great little conversation on delta and where delta can change when you're dealing with trend trading. That all said, let's go to this. You're going to get an email. It's going to be my 5 indicators for trading success. You're going to need to read it because that gives you the entry that I actually use for one of my trading programs. And it's a very profitable trading program. Just Steve and I have been talking about it, and we were looking at it yesterday, and I kind of shocked myself when I realized that it was up 135% for the year. It's absolutely phenomenal, 135% in a year. So, for those of you that have a $20,000 portfolio, you're talking about literally making $27,000. You get a free car and then stay with the portfolio going forward. It's been a really good return. I love it. I love trend trading, even when you have crazy market action like we've had this year. So I use a trend trading signal called a triple moving average. You're going to want to read more about it. I don't have time to go into it too much today. Make sure you look at that. Okay. And with all that in mind, this is how I actually use my portfolio. And I'm giving this away to you guys for free, so you can do it yourselves. Once I give you that trend trading signal, it's going to be in your email. And this slide right here tells you exactly how I make my entry. Triple moving average signal. I use 3 to 5 months to expiration, so it's a little bit lower gamma than what we're talking about today, 65 to 80 delta. So it's in the money calls. If you don't understand this, frankly, you really probably want to follow up with me and we can talk a little more, and I'd be happy to talk about it. And then we can discuss how I do this for the option trend trader signal. And then again, this is the result. Up 135% for the year. I know Steve wanted to get kind of jump on this. So Steve, are you there? Because I know you had some comments here.
Yes, I am here. Thank you very much, Keith. And you can catch your breath for just 1 second there.
Six or seven more breaths here while you're doing your talk.
Yes, yes, right? Exactly. Okay, great. We would like to let you know again, just to remind you that we do have a partner, third-party company known as Market Education and Trading Commerce. It is Stephen. I'm Steve, and that is Stephen, who runs that business. And he will gladly either call you or email you if you put your name, email address, and phone number in the chat box. That will be the signal for him to contact you. It'll probably be tomorrow, although if some of you are on the West Coast, possibly yet today. But Stephen from Market Education and Trading Commerce will contact you. He will have a special coupon code for you. That coupon code is 100 for you. That's 100 FORYOU. But he will have a lot more for you as well. And so if anyone, again, is interested in being contacted so that they can help you, so that Stephen can help you answer any questions or actually purchase any of our subscription products, that is his job, and that's exactly what he will do for you, and walk you through everything stem to stern, as well as giving you that coupon code again. And also there is a coupon code that can be used on the smartphone as well, which he will also give you. So either way, you'll be getting a nice coupon code, a nice discount code. That will be one of several discount codes that you get from having been on this presentation. So once again, just to finish up, if you would like to be contacted by Stephen from our partner company, Market Education and Trading Commerce, please put your name, address, email address, that is, name, email address, and phone number in the chat box, and Stephen will give you a call. And so hopefully Keith has had a chance to catch his breath again. And Keith, can I turn it back over to you?
Absolutely. So before I get involved, let me do a couple of ones here. We have a couple of people, Norman and William. Let me make sure that we've got your contact information. And Steve, if you don't mind writing them down and throwing them over to Steve N, that would be good. And then we had a question from Bob. Do I have longer term historic results on the trend trading portfolio? Absolutely. So one of the things that I actually like to try to explain to people, 2020, yes, very non-typical, not asymmetric return, right? I think one of the most important things to see here with this portfolio is that when the market had its major downturn into January, February, and March, this portfolio actually had, yes, leveraged returns, which means leveraged risk, but the return profile was only down, and please don't quote me if I'm wrong. I can get you the specific numbers, but I think it was down about 22%. Yeah, that's not good. But when you're dealing with things like 136% for the year, I think the little downturns can sometimes pay off. So it's a little over 20%. Not good, not what you want. But that's why we have defined risk. And the market on its own was down close to that percentage itself. So there are COVID crippled sectors. There are COVID benefactors, frankly. And I think that we saw a tech sector that tried to identify them, and that's why I use these technical signals to try to find those those sectors that are actually benefactors of COVID. There are many of them. When we look at sectors that have done better, I mean, you think about Take Two or Activision. Video games have actually done really well. Biotechs have done really well in the last couple of weeks. The fortunate thing is when I'm looking at this profile, it's mostly about tech, which means you're not necessarily looking at retail, but Amazons and things like that can do really well in a stay-at-home environment. So at the end of the day, the results speak for themselves. 1 or 2x kind of on the downside and multiples on the upside, and that's what's been beneficial to dealing with options. Defined risk on the downside, major leverage to the upside, which is what we always want to achieve. I'm going to talk about something crazy today, and that's third order Greeks. So we've talked about second order Greeks, and third order Greeks are a little weird. So when you think about third order Greeks, we're talking about those changes in something that changes our gamma. So gamma is a second order Greek. Gamma is the change in delta. Third order Greek is what happens in a change in underlying price to change our delta. And then what happens on top of that to change our gamma. If we do change in passage of time, what happens to a change in passage of time to not only change our delta, but also to change our gamma, which is going to change our delta. This is where all the leverage comes in. So we're looking at that curvature and we're trying to figure out where it comes from. It comes from many different sources. Okay. So let's kind of play with that. Norman, I'm going to come back to your question at the end. Remind me if I miss it. The profitability of an at-the-money $100 call with a $5 initial cost. This is long call at expiration. We have a line, right? Line across, and then line up. This is just showing us our symmetry to stock. Where gamma kicks in is that curvature of the green line. So at 100 delta, let me see if I can just draw this on here just so you guys can all see it. It's really fun for me to do this. Let's see. I'm going to draw. I'm going to use maybe red. We're going to have a lot of fun. Here. So for those of you that don't remember calculus, the slope of that curved line is what we're dealing with when we're talking about gamma. Okay? So big math stuff. I was a math major in college, so I like math. But when I look at that slope, this slope is gamma. If I clear it, actually, I'm not even going to clear it. I'm going to just show you again for a higher strike. Let's do this one right here. This is closer to 100 delta, represents more of a stock position. You can see that one is a higher slope. And then down here is going to be a lower slope. And you can see that the delta of a stock option that's out of the money at $85 in the stock price is significantly lower. So look at these 3 red lines that I just drew. The one that I first drew is basically a 50-50 shot. We don't know if this stock is going to be in the money or out of the money. We just are going to assume that we're flipping a coin and hoping we're right. If it comes up heads, we win. If it comes up tails, we lose. And the nature of the game that we're trying to play is saying that if I flip a coin that comes up heads, I win $2. But if I flip a coin that comes up tails, I lose $1. So I have a positive expected return, right? If I flip a coin and I can tell you that heads is $2 and tails loses $1, you're going to make money over time, unless it's a, broken game. What I'm trying to do when I'm doing a trend trading portfolio is find more like that last line I drew, where the options are in the money, high probability of success, and gives me a little bit of gamma on top of it because the options are slowly increasing in delta. Okay. Let me clear all these drawings. Uh-oh. There we go. Let's talk about the third order derivatives. Not second order. Second order is gamma. Third order is the change in that second order Greek called gamma, relative to other changes in sort of our first order implementations. So when you think about changes in underlying price, how does that change our options portfolio? Well, that's speed. Speed is the change in gamma relative to the change in underlying price. Let's talk about what that looks like. Color is the change in gamma relative to the passage of time. And I swear to God, I did not name either of these Greeks because frankly, speed and color are not Greek words. They are just random words that you and I could come up with anytime. And ZAMA, which does have a little bit of a Greek nature to it, is the change in gamma relative to the change in implied volatility. And that's a little bit more fun because that one has some craziness to it. And I'm going to show you a really good chart on that so you guys can understand it. Hold off on that before we get there. First one, let's visualize gamma. We did that already. Let's just go straight to visualizing speed. Call option delta over price and time. I'm going to show you this chart again to visualize color. But again, speed is the change in gamma relative to the change in underlying price. So you can see when a stock is, an option is at the money, you have quick changes to the delta, which means it is big gamma. When you deal with an option that's far out of the money, that delta doesn't change. Why? Because the probability of a stock going from 100 to 120 doesn't change that much when a stock goes from 100 to 101, right? So remember, our delta can be a proxy for the probability that the stock finishes in the money. When a stock goes from 100 to $101, higher probability that it finishes in the money. When a call option expiring a month from now with a $120 strike, we see a stock go from 100 to 101. We're not going to see a high probability that stock's going to finish in the money. So that option's literally just about the same. So probability of finishing in the money for a $120 call strike doesn't change much from a move from 100 to 101, but it does change a lot from a $100 call strike. Okay. Stocks options that are at the money tend to have more gamma because they have more fluctuation with the market. A $100 call is going to have much greater implication from a small move in the stock, knowing whether or not it's going to finish in the money. So we're talking literally about that probability effect, and that's where these at the money options are more important. So at the money options, more gamma. Far out of the money options, less gamma. That's a simple rule of thumb. Far out of the money options, less gamma. At the money options, more gamma. Repeat it over and over again. That's where you're going to get your benefit when you find an option that's underpriced. It's going to be at the money is where you get your quick delta benefit. Okay. That said, swing trading is much more about trading out of the money options. Oops. Let's go back one more. Color. So reminder, color is color is change gamma relative to passage of time. So when we look at time to expiration, you get much more slope on that delta when time is less. Why? Because if I told you that the stock is trading $101 and we're dealing with a $100 strike call expiring in 4 minutes, you're telling me that the probability of the stock being worth more than $100 is pretty high. But when I have a stock trading $101 and the option expires in 7 years, you're going to tell me that there's kind of a 50-50 shot on whether or not it's going to expire in the money. So that's what color is we know with high probability when time goes down, gamma goes up. That's what color is. Color is gamma increasing as time goes down. Okay. And when you're dealing with far out of the money contracts, those out of the money options, it gets a little crazy. Let's do ZAMA. Weird one. ZAMA is changes in implied volatility relative to changes in gamma. So as implied volatility goes up, we understand that gamma actually goes down. Why? Because if a stock is expected to move in a small amount, it's almost like that stock has less time to expiration. So when a stock has little chance of moving, we get a lot of gamma. And when a stock has a lot of chance of moving, we get less gamma. That's what ZAMA is. This is weird, right? But at the end of the day, that's what we have to always consider when we're trading options. We've got ZAMA, color, speed, on top of VAMA, VAMA, and everything else that we talked about last week or a couple weeks ago and a couple months ago. We have so many different ways to look at options that it just gets crazy. And that's why I go through this. What do I want when I'm trading a trend trading program? I don't necessarily want gamma. I want delta, which is what we talked about a few months ago. I do want a little gamma because I want that little bit of leverage. And frankly, I want a little bit of defined risk. I do want Vega because Vega gives me a little defined risk too. And they give me a little bit of more upside if the market moves. And I want gamma because it gives me a little more upside. And I want that leverage. At the end of the day, I am still doing this. I'm using my triple moving average signal. I'm structuring my trade. I'm sending you that spreadsheet. If you have other questions, you should feel free to email me. And that's what we're going to go through next. If you have questions about rolling positions, because I build cash all the time, trend following positions are always building cash the way that I do it. It's great. It's really good for like my retirement account and everything else. And I think that people like my kind of unique perspective on that. Email me, Keith@optionhotline.com, call me 312-600-8004. Watch for that email, webinars@optionhotline.com. That's the one that's, if it hits your spam, go to your spam folder, mark it not spam, and then make sure you read it because this is good stuff. And I'm giving it away for free. I usually sell it. So thank you all for attending and reading that. This is sort of my favorite little visual representation. We're talking about ways to build hundreds of dollars into thousands of dollars. If you want to address the problems that are going on with your portfolio, if you want to address the problems that you are currently dealing with, you should call me. I gave you that information. Reminder, my option trend trader portfolio is up 135% this year. You should call me. 135% on a $10,000 portfolio is $13,500. 135% on a $20,000 portfolio is $27,000. Why wouldn't you call me and we can figure out what you're doing wrong and then try to get you in touch with the right financial advisor to make you do things right. What we're going to do today, I'm going to go through this with Option Hotline. You're going to go to optionhotline.com and you're going to pick the way to do this is go to optionhotline.com. Sorry. You go to optionhotline.com and you're going to go and you're going to click on Option Trend Trader and you're going to sign up, right? I mean, 135%. Why wouldn't you sign up? It pays for itself in a matter of months. But you go to commentators. Sorry, we'll go to store and make it faster. We can go to store. Option trend trader here on the second. It's normally 197 a month. It's normally 1997 a year. You go to an annual, you add a cart. $2,000 a year, frankly, it's a steal still, because 135% a year, you're doing well. We apply amazing year, and you're getting $997 a year every year. So it's not just this year. Every year on renewal, $997 a year. It's less than $1,000. You're getting a super deal for this portfolio. You're learning how it works, and you can apply it however you wish. So that's the main goal for me, is turning education into profit for everybody. And that's what I want everybody to understand how to do. That in mind, I got a lot of questions here, and so we're gonna get into those. Let me throw back up my contact information here, and we can go through some of these questions. Thanks to Steve in advance for moderating those questions.
Sure. Thank you, Keith. And I have some more questions here. So you've got access, I've got access. So we can probably just go ahead and get started with some of them. We agreed to get back to Norman first, I think. And Norman's question is, what is the ratio of wins to losers? How often do you sell the option long before they expire?
Absolutely, Norman. This is actually a great question. So this goes back to, I think that we have another white paper that I normally send out and whatever. But at the end of the day, the idea is that the ratio of win to losers is probably about 2/3 winners, 1/3 losers. I don't have the exact statistic. I'd have to look back. Follow up with me if you want, and we can figure that out exactly. I do not sell the option before they expire. I roll the position. So, we can go back to that idea of having a $100 stock. And instead of turning it from a $100 strike call expiring in 3 months, when we start to see the options nearing expiration, what I do is I roll it to a $105 call, for example, and use that to generate some cash flow as well as staying within the position. So, at the end of the day, we don't sell the long option before it expires. We actually roll the position. Hopefully that kind of answered the question there for you, Norman. And if not, feel free to email me, keith@optionhotline.com, or call me 312-600-8004.
Okay, great. Thank you, Keith. Next question is from Bob, and kind of a two-part question. First is, can we see the longer trend trader portfolio performance somewhere?
So what I've done here, only for your guys' benefit, was to try to throw let's see if I can pull up the portfolio returns here for the year. So this was for the year. We have had this portfolio in for a little longer than the year, obviously. And this is the, I guess, base response to what's the performance somewhere. I mean, frankly, at the end of the day, even during a market downturn, to have a comparable downturn to the normal market is probably pretty good, especially when you get the leverage to the upside. The coupon code was amazing year. Typing it all in one word, no caps, amazing year. So this is generally, or speaking though, when you're dealing with a leveraged portfolio, you're looking for the big return as well as that defined risk to the downside.
Okay, great. Thank you, Keith. We have another question from, hopefully I won't butcher this name. I believe it's pronounced Umesh. Hopefully I pronounced that right. It says, I like your analysis. Is it possible for a trial month of subscribing to the Options Alert newsletter before committing to the entire year. And so can it be a 1 month subscription? And Umesh has his email address on here as well. So I can start by answering that and then let Keith take over. Yes, we have both yearly and monthly subscriptions. Keith, you want to take it from there?
Yeah, no, I was gonna say we basically, I mean, we have both yearly and monthly subscription options. I think that you might be best served with an email to either myself or Stephen Fox here. Uh, we do have really good options to try to reduce the cost. But at the end of the day, you kind of get what you pay for. So we do have the annual that I just proposed. Amazing Year is the subscription. We are going to send you an email with some monthly discount codes. Keep an eye out for those. And you should certainly put yourself in touch with support at optionhotline.com, webinars at optionhotline.com if you are looking for something a little different from what we're offering. And we can certainly try to work with anybody on, I mean, at the end of the day, the goal here is not to get you to pay me, which I appreciate, but at the end of the day, my goal is to try to make you guys smarter traders. And so email me and we will try to figure out ways to work within your goal.
Great. And Umesh, we do have your email address right here, which I will forward to both Keith and Stephen from Market. So you can expect that email coming to you with those coupon codes, as well as everything else that we've talked about. So we have just, I think, one or two more quick questions. And that is, Keith, first, with the election over, maybe, have you or are you planning to adjust your positioning?
So one of the things I always do with this portfolio is I'm always looking to adjust. Basically, when you've got a new trend forming, there's constantly opportunities to adjust, right? So that's what we're dealing with a trend trading portfolio, is trying to find those adjustment opportunities. Most of what I'm dealing with here is the NASDAQ 100. We've got 100 names to look at, and it's a question of whether I want to be more hyper focused on biotech or gaming stocks, or just your kind of big five, the things. And I'm always kind of playing around with that. I see another one coming in here, Steve. I don't know if you saw it already, but what's the difference between big league and trend trader?
Yeah.
So Bob, it's a great question. What we've done here with trend trader is given a little bit more of an opportunity to understand some of the risk parameters that go along with trading a trend. Big league does have a great exposure to some of those higher dollar names. So what I try to do with option trend trader is that it doesn't necessarily approach names that are $500, $600, $700 per share. Frankly, not everybody can play that as an outright or even with an option. But when you're dealing with big league, you get exposure to all those names that have that higher dollar price. So I would say the big league option service is a little bit more built towards the savvy investor with a little bit more equity in their account. An option trend trader can be really applied to almost anybody.
Okay, great. I think that wraps it up for the questions, unless you see anything more, Keith, but I don't think so.
Yeah.
And for those of you, we still have a good group still on. So those of you that are on, please stay with us. I am going to do